It manufactures three products based budgeted details of which are set out below. So product T, product F, and product G. Budgeted annual production is given. The batch size is given. Batch machine setups per batch is also given. Three cost pools have been identified. Budgeted machine setup cost for the year are 180,000. The budgeted machine setup cost per unit of product F is dollars. So the way we have learned about the principles of ABC, it is the same thing. See, this is only the difference is this is used in budgeting. Otherwise, the way the overhead costs are allocated, it remains the same principles. Okay. Um, the question is asking us using ABC. The budgeted machine setup cost per unit. So first we need to know what is the machine setup cost which is allocated to all the three products. After that we have to divide by the number of units and find out. That is what is the way in which overheads are allocated. The total amount of overhead costs incurred or anticipated to be incurred. This is budget. No budgeted machine setup cost for the year are 180,000. So this 180,000 first should be allocated to E, F, and G. Then after that, we divide by the number of units to find out what is the overhead cost per unit of each of the products. That is the logic. Now here, if we have to distribute this 180,000 or allocate this 180,000, we need to choose the cost driver. The total amount is 180,000, but we need to know what is the cost driver. So what do you think is the cost driver, suitable cost driver? From the given details, what do we understand? We have, because it's machine setup cost per unit should be the case. But machine setups per batch is given. How many batches we've done? Similar type of question earlier also. So if we have to allocate the machine setup cost, there are certain other details also which we have to first look into. The batch size is given. The setups per batch is given. The number of batches, the number of setups per batch are 5, 3, and 9. But how many batches is not given. So we just have to work out with these two things. The total output is given, and each batch has how many number of units. So that gives us what is the batch number of batches. Then we have batch size. So the total number of machine setups per batch, if it is 5 and number of batches are 375, so we just have to multiply these two things. So this becomes the cost driver, that is number of machine setups. Total cost is 180,000. So allocate in this particular proportion. The total is 25,875. Per unit, you just have to divide it by the number of units. So if this is machine setup cost, divided by the number of units. Let's take up the next question. After 99, 101 is done.
Yes, ma'am.
101 is done. After 101, we didn't do 104 because we didn't do forecasting techniques, isn't it? So we didn't do 104. Then how about 106? Value to be included. No, we didn't. So let's take it up. 106. The question says, is preparing its cash budget for February using the following data. On one line is in the cash budget is for purchase of raw materials, raw material J. The opening inventory of J in January is expected to be 1075 units. The price of J is expected to be $8 per unit. The company pays for purchases at the end of the month following delivery. Production is expected to be 4,300 units in January and 5,300 units in February. And each production unit uses 1 unit of material J. At the end of each month, raw materials inventory is expected to be 25% of the requirement of the following month's production. The value for purchases of J to be included in cash budget for February is dollars. Why do I have a feeling that we have done this question?
Yes.
Done, we've done. 106 is done. One zero seven is not done. K has determined a cost driver. I hope you're seeing. K has determined a cost driver rate for quality testing as $850 per test. During the year, they were actually on average 50 tests per month, giving an adverse variance on the total cost for quality testing of 102,000 for the year. The budgeted cost per month for quality testing is dollars. K has determined a cost driver rate. Rate is given as cost driver rate for quality testing is $850 per test. So that's the first point. The second point, during the year there are actually on an average 50 tests per month. Giving an adverse, when would they have an adverse variance on the total cost for quality testing of 102,000 for the year? When can there be an adverse variance? We are talking about a cost variance, isn't it? So if it is related to cost, the adverse variance arises when the actual consumption or actual cost incurred is or actual usage of whatever is that variable. If they have consumed more, if they have incurred more, if they spend more than the budgeted thing, then there would be an adverse variance. So that point first we have to understand. They have determined a cost driver rate. So the determined is a standard or the budgeted rate. Budgeted rate stands at $850 per test. After that, the actual number of they were actually on an average 50 tests per month. So actual tests were 50. After that, it says that giving an adverse variance on the total cost for the quality testing of 102,000 for the year, 102,000 for the year. The uniformity is missing because 50 tests per month is what is mentioned and the total quality cost is given for the year. So let's first make that as per month cost, whatever is the amount of um, the variance which is on the total cost for quality testing of 102,000 for the year. Let's make it as per month. So that is 800 and sorry 8,500. 8,500 is the adverse variance. So the standard rate which is given is, we see 850 per test. The concept here is, if it is an adverse variance, so it would have been that the actual quality testing is greater than quality testing is greater than the budgeted quality testing cost. We, because the details are related to the cost, budgeted quality testing cost. So by how much, is it is by per month it is 8,500. That is what we have understood till now. When the costs are calculated, the budgeted rate into the number of budgeted quality tests. Then we have the actual tests. Actual tests are given as 50 into whatever is the rate, that is multiplied. So we have two sets of cost. One is the actual cost and one is the budgeted cost. Now the actual cost is more than the budgeted cost by 8,500 per month. So 8,500 per month is, if the rate is given at the rate of 850 per test, how many budgeted tests are there is what we can find out. So after we find out the number of budgeted tests, because to calculate the budgeted quality test cost, we need to multiply the rate per test into number of tests. So that has to be first calculated. Um, Number of tests in excess of budgeted tests, because variance is talking about 8,500, no, budgeted test is equal to, we have 8,500 is the variance per month divided by rate is 850. So 10 is the case. They have spent or they have used more number of tests to the extent of 10 tests. The actual number of tests which were taken up during the period was 50. So how much would have been the budgeted number of tests? Less than that. 50 minus 10, because it's an adverse variance. So now on that note we can write budgeted number of tests are actual test minus variance. So actual tests are 50, 50 minus 10. So that is 40 tests. We are asked to find out what is the budgeted cost per month. Budgeted cost per month. Find out. How do we calculate? We know the rate. We know the number of budgeted tests. So budgeted cost per month is equal to the number of budgeted tests, which are 40, into rate per test, which is 850. So 40 tests into dollar 850. After 107, 109. One zero nine is also done. 110 is also done.
Ma'am,
Yeah.
we didn't complete 110, ma'am. We did it half, ma'am.
Nine we didn't complete, or 10 we didn't complete.
9 we completed, ma'am. 110 only we did it half, ma'am.
Okay. Let's take it up. A company has the following budgeted sales figures: month 1, 2, and 3. The sales figures are given. What happened? It looks like completed. No, it.
Sorry, ma'am. 110 is completed. Actually, I have a doubt in that, so ma'am. That's why I noted
Okay,
down.
no problem. We'll take it up. 110. No.
Ma'am, actually, I have a doubt in that time frame, ma'am. Why it is actually 1 month after the sale, ma'am? Because it is like given as one within 1 month, no, ma'am. So we will be expecting our amount within the sale of that month, no, ma'am.
In fact, actually, I think I started doing that way, and then we were not able to. I mean, I think you
Yes, ma'am.
only have suggested, so
No,
then I wrote it down below that. Generally, it goes with that. If it says that if it is within 1 month, so the expectation is the sale was made. Usually, if nothing is mentioned, the transaction, whatever transaction takes place, it is on the first day. If I mean, there could be certain other things also which can be included in the question. If it happens to be on the first date of each month, then in that case within 1 month is the credit sales, also those who are availing that discount of 2% also would be paying within the same month. So I have done the calculation here, then later on I dragged it, I put it
ma'am.
like this.
Ma'am, no, ma'am, this was the right answer, but I didn't understand, ma'am, because on that day, Leo suggested this, ma'am. Then we got this answer, ma'am.
Okay. I mean, it is basically, finally we assumed it that sales were not made on the first day. So if it is randomly made any date, any other date will fall 1 month after that. So it there is a possibility that it can fall into the next month. So that is the only assumption. Therefore, wrote the assumption there. But technically, when the question is silent about it, the usual assumption which is taken up is the sale takes place on the first date. Sales also can take place on the last date or average on any date during the month. So if that is the case, and if they have sold the units on the first day, so the credit sale first payment, which is offering a discount also should fall into the first month only. But maybe that assumption is taken up that the sale was not made on any on date on first, but on any other date. Even it happens to be on second of each month, second of that month to the next month second. So it technically falls on in the second month. So on that note, we have taken it to the next month. So that's the only thing. It is purely based on an assumption.
Okay, ma'am.
You can write a note also there. See, if we are, let me put it this way: if it is a multiple choice question, obviously the options would be there, and then you can test it. If it doesn't work out, you can drag it and then put it there. Since this is a fill in the blank, you are not sure about it. You write your own assumption. You write your own assumption that the sale took place on the first date or any other date. So it is up to you that how are you looking at this one. The professional exams, it is not necessary that only one standard answer they stick to that. They want to test the student whether they can take up situations here and work it out. Here we have to look at the procedure of how the calculations are taken up. So I assumed I started working out this solution with an assumption that sales were made on the first date. Maybe the solution was it is some other date other than the first date.
Okay, ma'am. Now I understood.
One eleven we didn't, I guess. Did we? I don't know. 111 we didn't. We'll take it up 111 because activity based I taught you in the previous class, so no question was solved in the class before that. The question says CJD Limited manufactures plastic components for the car industry. The following budgeted information is available for three of its key plastic components W, X, and Y. The per unit details are given. The selling price, direct material, direct labor, units produced and sold. The total number of activities for each of the three products for the period is as follows. Number of purchase requisitions, number of setups, overhead costs have been analyzed as follows. We have two different overhead costs. One is receiving or inspecting quality assurance. Next one is production scheduling and machine setup. So what is the first thing? If it is an activity based budgeting, the principles of activity based are assumed. Then for each of the overhead cost amount, we need to first take up what is the appropriate cost driver. So receiving, inspecting, and quality assurance, and then production scheduling, machine setup. So what can be taken up as the cost driver? There are two different overhead costs: receiving, inspecting, and quality assurance. If that is the case, then the appropriate cost driver, the number of activities for each of these products for the period is as follows. So we can link the overheads with the cost drivers. First, let's mention what is the overhead cost in receiving and inspecting. What's the cost driver? The cost driver is number of purchase requisitions. The next one is number of setups. Then what will be the ratio? 12 is to 18 is to 20. 12. And for the other one, it is 24 is to 26 is to 30. 24 is 30. What's the total amount? The total amount is 1,400,000. So let's take it up. 1,400,000 is equal to 1,400,000 into 12. That 12 by 50, no? 12 and 18 is 30. 30 plus 20 is 50. So 12 by 50. Twenty divided by 50. For the machine setups, cost is 1,200,000. For that one also, let's take it up in the same fashion. So 24 by 80. We are asked to find out what is the budgeted profit per unit. So these are only the overhead costs. Now, what are the details? We have the selling price, we have the direct material, direct labor, and the number of units produced and sold. So, since these are given as per unit, and this is total cost, let's make these overhead per unit. This is total overhead cost. What we have calculated is the total overhead cost which is charged to that. If we are looking at that, they are asking us to calculate what is budgeted profit per unit. The rest of the details are also given as per unit, that is selling price, direct material, direct labor. So let's make this also as per unit. So this is total overheads.
Ma'am,
Yeah.
ma'am, for product W, the inspecting quality assurance is 3,36,000, ma'am.
The rest of them.
Yes, ma'am, they are fine, ma'am.
Then let's write units produced. $10,000, $15,000, then $18,000. Find out overhead cost per unit. Now to find out budgeted profit per unit. So let's start once again. We'll start with selling price. Selling price is 200, 183, 175. Less cost. We have a set of costs. One is direct material, the other one is direct labor. Then overhead cost. Per unit costs are, we have here it as 50, 40, 35. Then next we have 30, 35, and 30. Next overhead cost. Find out the total cost. They have asked only for product X, so product X answer would be 48.4. But otherwise, also for any other thing, also if they ask, we can have this one. So this is question number 111. One twelve, 113. Any idea? I don't think we have done. 112, 113. Let's take it up. Oh no, we've done. We solved these two questions, 112 and 113. Question number 114. It says, these latest estimate for trade payables outstanding at the end of this year is 45 days. Estimated purchases for this year are 474,500. DB is preparing the budget for next year and estimates the purchases will increase by 10%. The trade payables amount in dollars outstanding at the end of next year is estimated to be the same as at the end of this year. The budgeted trade days, payable days at the end of the next year are dash days down to the nearest whole day. Trade payables outstanding at the end of this year is 45 days. Did you do turnover ratios? Which this is P. Did you ever get a chance to do the ratio analysis and turnover ratios? Any paper? I have no clue. Did you work out turnover ratios?
Ma'am, we did a few turnover ratios in school.
Not school. I here in this graduation program as a part of this program anytime, because we cannot base on that experience. If it was done here or it was not done here is the criteria. This is still P1, no? So I don't think you must have done anything related to turnover ratios. Okay. I'll try to put it as simple as possible. Try to explain that. Let's see how much we can take it up. The details given are, first let's see what are the details given. Trade payables outstanding at the end of this year is 45 days. Estimated purchases for this year are 474,500. DV is preparing the budget for the next year and estimates that the purchases will increase by 10%. So the issue relating to the budget part of it is they are anticipating that the purchases will increase by 10%. But what are the purchases of the current year is what first we have to understand. So first we need to find out what are the purchases and the current purchases, and apply the anticipated changes of 10% for the next year, because the budget is prepared. So at the time of preparation of budget, if they have to include the details related to the purchases, they need to know what are purchases. So the base is given as at present these are the details. So from this we can find out what are the purchases. If trade payable outstanding days is 45 days, and the purchases for this year we have it as 474,500 with these two details, and the anticipated increase in purchases are 10%. The point is, what are the trade payable days at the end of the next year? What is trade payable days formula? The first thing, let's work it out. What is the formula for trade payable days? So what is the credit period basically, which is extended by the supplier to make the payment? So the formula for trade payable days is, in a year, if there are 365 days, in a year of 365 days, they are allowed a credit period of 45 days. So what is the base for that? Since the transactions for the um, purchases were taken up, so purchases turnover ratio, or what we call it as very specifically payables turnover ratio. How quickly, so there is a way in which turnover ratios are treated. All turnover ratios, the logic to remember about the turnover ratios is, any turnover ratio, name it, and then we see that the same rule applies. We have the meaning of turnover is usually it is sales. So sales or anything related to sales. But if we are talking about payment part of it, only in that context, the meaning of turnover changes. Then turnover becomes the purchases related thing. So either it, whatever is the turnover, of course, the meaning of turnover differs from situation to situation. But the point what we have to remember is, we need to understand that turnover comes in the numerator. Always turnover ratio comes in the numerator. Whatever is the other variable like stock turnover, capital turnover, working capital turnover, asset turnover, capital turnover, no matter whatever is the point, turnover goes to the numerator, and whatever is this other variable, whatever we are talking about, asset turnover, fixed asset turnover, so name it, and whatever is the turnover ratio, the other variable, the prefix part of turnover ratio comes to the denominator. Okay. So we need to know here in this particular context, it would be payables turnover ratio. So the denominator we would have payables. If the turnover ratio is calculated in the way of, the numerator will be turnover divided by payables. But what is turnover? So I said it is basically sales, but payables and sales are not connected. Why would payables arise? Payables would arise because of credit purchases. They have purchased, but they have not made the payment. So there is a payable which is arising. So credit payables. If you are looking at what is credit purchases, on account of credit purchases, there is a liability which is arising called as payables. So credit purchases divided by payables is a turnover ratio. This turnover ratio, whatever is this turnover ratio, if that is taken to trade payables day, the formula is payable days formula will be 365 divided by payables turnover ratio. In a year of 365 days, sometimes it's also taken that in a year there are only 360 days. That also is an assumption, but that would be mentioned in the question about what are the number of days. If the question is silent, we can go ahead with 365. Now, payable days are 365 divided by payables turnover ratio is equal to the value is given to us as 45 days. So can we find out what is purchase payables turnover ratio? Payables turnover payables turnover ratio. So payables turnover ratio will be 365 divided by 45. Once we know what is 365 divided by 45 payables turnover ratio, credit purchases, credit purchases are known to us. So we would know what are the payables for the current period. The question is asking us what are the payables for the next period. I hope the logic is clear till here. We are only halfway through. But is the logic clear? How is payable turnover ratio calculated? The formula goes as credit purchases divided by payables is the payables turnover ratio. So the formula of trade payables days is equal to 365 divided by payables turnover ratio. If payables turnover ratio, to find out that, we have to take 365 divided by 45. Once we know what is payables turnover ratio, then we can substitute the formula for payables turnover ratio is credit purchases divided by payables. So we can find out what are the current period payable. But the question is not asking us about the current period payables. The question is asking us about what are the next period's payables. Okay, the question is budgeted trade payable days at the end of the next year are dash days. I'll erase the screen. I'll erase the screen and then 'We are given what are the estimated purchases for this year is 474,500. Is it coming up to the same amount? 365 divided by 45. So how much is that? 365 divided by 45.
8.1.
8.11 times. If it is 8.11 times, we already know what are credit purchase. We can find out what are the payables for the current period. Payables for the current period is equal to credit purchases are 474,500 divided by 8.11. But the question is asking about the next period. So let's work it out for the next period details. Current purchases are 474,500, but they are expected to increase by 10%. So purchases for the next period is equal to 474,500 into 10%. So 110%, that can be written as 1.1. So purchases for the next period are okay. So this is what we have. Number of payable days, purchase billing, payables. So we need to know what is payable turnover ratio for the current period, for the next period. Payable turnover ratio for the next period is the credit purchases are there. Payables we need to know. Unless and until we know payables, how would we know what are payables? The trade amount. The trade payables amount in dollars outstanding at the end of next year is estimated to be the same as at the end of this year. So that is the clue here. So the payables will be the same. Payables at the end of next year is equal to payables. We already got the amount as 58,508. So is equal to 58,508. I think from here we can work out what are the trade payable days at the end of the next year. Is equal to 365 divided by payables turnover ratio, isn't it? Let's first calculate what is payables turnover ratio is equal to credit purchases are 521,950. 521,950 divided by the payables are 58,508. 58,508 is equal to. Okay, so we got it as 8.92. So now trade payables days will be 365 days divided by 8.92. Which is equal to we got it as 40.91 days, or just round it off, and then because it is number of days, 41 days. That will be the answer. The clue is this one. The trade payables amount outstanding at the end of the next year is estimated to be the same as at the end of this year. That's the clue. That's it. Just substitute and then arrive at the answer. You don't have a festival holiday today.
No, ma'am.
But actually today is Monday. Suppose the class was supposed to start at 5 to 6. You didn't remember. I was just trying because I had my class from 3:30 another college. There was a clash. They didn't join. So I was testing whether you people would join. You joined and then I took the class. That's how it happened. But otherwise, every Monday your class is only for 1 hour. Last Monday also I made the mention about this one. So I thought anyway you're there, so I better take the class. Okay. Every Monday you join at it's not 4 to 6. It's only 5 to 6 only on Mondays. Okay. We'll
Okay.
continue. We'll continue further. So after 114 is done, then 115. Looks like we've done 115. Huh. Then let's take it up 116. Let's take both 116 and 117 to the Excel file. Question number 116 on the screen. A wedding company provides two wedding packages, the silver and the gold. Budgeted information for the forthcoming year is as follows: silver and gold. We have sales volume 400 units and 200 units. Then the revenue is given, variable cost and contribution. The director wishes to change the sales mix so that while total sales revenue remains the same, the sales mix by revenue is 25% silver and 75% gold. Um, the revised budgeted contribution from gold package is, so just that there is a change in the sales mix. The other things, it says that the total sales revenue, how much is total sales revenue? 400,000, it is totally 800,000. So it is now, as of now, it is 50-50%. But so out of 800,000, they would want to have their um, sales for silver as only 25% and the remaining 75% for gold. By making that change, we need to find out what is the revised budgeted contribution. Right? The amount of sales is changing, but the relationship what it has with variable cost will not change. Variable cost is a cost which varies proportionately with the sales. So if the amount is proportionately changing, the sales revenue is changing, the variable cost also will change proportionate to the changes in sales. Variable cost by definition is that. Right? Therefore, make the changes according to that and then find out what it is. So let's put the solution here. 116. There are two products, silver and gold. So take silver and gold. The total sales revenue also, we understood the total sales revenue is totally 800,000 because 400,000, 400,000. But the proportion in which these amounts would be henceforth will be as 25% for silver and 75% for gold. Um, there are two ways we can take it up. After we do that, proportionately we change these two variable costs and then we can arrive at that. Let me put this one so that it's easy for you to understand. If it is fine, otherwise we'll see what is an alternate method also to do this one. So we have the total also. Total sales revenue is 800,000. Then silver will be only 25% into 0.25. And this will be 75%. When sales revenue was 400, variable cost was 160. So now how much will be variable cost? Proportionately we change it. So the logic will be when the sales was 400, variable cost was 160. Now it is only 200. So how much will be variable cost? So that's the logic. So for 200 units, 200,000, how much is the variable cost? So that same logic we have to apply and then work it out. And then the resultant figure after we deduct the variable cost, it is contribution. So variable cost, by definition, variable cost is a cost which varies proportionately. So here we can put it as 400 is 160. So 200 is how much? Is equal to 200,000 into 160,000 divided by 400. 1, 2, 3. Now, the same logic we apply for gold also. Gold will be when sales was 400, variable cost was 200. Now sales is 600, so it will be 300,000. Simple logic. 400, 200. So 600 into is equal to 600, 1, 2, 3 into 200 divided by 800. Did I make a mistake? 600,000, 200,000, 800,000.
Ma'am?
What did I do? Mistake.
No, ma'am. Actually, I have a doubt. Ma'am, that variable cost will be calculated on the sales volume, no, ma'am. Why we are adjusting according to the revenue?
Sales cost, variable cost is calculated according to the
Ma'am, no.
Your question I didn't understand. I'm sorry.
Ma'am, I have a doubt, ma'am. Actually, is variable cost is calculated on sales volume, ma'am, or the sales revenue?
Sales output. As the output keeps changing, the variable cost also keeps changing.
But in this case, why we need to adjust it according to sales revenue, ma'am?
But because the selling price per unit is not changing, no? The per unit value is not changing. So the quantity is only changing. Quantity changing, the change is not happening on account of the selling price per unit. It is happening on account of the number of units sold. The total sales revenue remains the same with no mention about the selling price per unit is changing. Okay, if this is not, I also told you that I will show you another, but at this one also, why am I getting it wrong?
4 lakhs in the
200.
denominator. And wouldn't it be a variable cost into 6 lakhs first? Because our adjusted is 6 lakhs.
This is 200. So 600. So 600 into what did I type? So 600. What not figures I wrote? This is 400. Let's. I mean, this what we have done is correct, but I will also show you another alternative. Your other alternative is, see, the quantities, the proportion of the quantities are changing, but the total revenue, it would be the same is what is mentioned. As of now, sales volume is 400 and 200. That is how they are selling, and the total sales revenue is 400,000, 400,000. So how many, what is the price per unit? What is the variable cost per unit is what we have to find out. If we find out that, see, the number of units are 400 and then 200. If sales is given to us as 400,000 and then 400,000. So what are the total number of units? Units will be this divided by 400. It's not units, selling price. Selling price per unit will be 1000 per unit, and similarly variable cost, the total variable cost is given as 160,000 and 200,000. Find out what is variable cost per unit. 160,000 divided by 400 units. So this is 800. If we multiply that also, we would get the same thing. See, the total revenue, if it is 200,000, 600,000, because the total sales revenue is the same. In this case, if this is the case and the selling price per unit is 1,000, how many units did they sell? That can be, for the new case, new sales revenue. New sales revenue, we have it as 200,000 and 600,000. So how many units did they sell? That's the concept. So number of units which they sold are, the selling price per unit, we already got it as 1,000. So 200 and 300. So is that 25% and 200 and 300. The variable cost per unit is also, variable cost is also given per unit 400, 1,000. 400 into 200 gives us the total variable cost. Total variable cost will be, we already got variable cost per unit 400 into the total number of new units which are sold is 200. We got that one. Similarly for the next product also. That's the logic. First one is simple, in one simple step it gets finished. But the second one, we need to work out the other details also and then find out. So here if we can do that. The only thing why we went proportionately is um, the total sales part of it, the proportion in which the number of units sold is differing. No other variable, whether it is selling price per unit or the variable cost per unit, these things, there is absolutely no change. So therefore, for that reason, variable cost is the cost which varies proportionately with the output. It is only the output which is changing. Price per unit, cost per unit, there is no change which is mentioned. For that reason, we are directly calculating it proportionately. So the logic of silver is, if it is for 400 units or 400,000, because we are taking it as the total sales revenue. For 400,000, if the variable cost is 160,000, when the sales revenue changed to 200,000, for 200,000, how much is the variable cost, total variable cost? So we got the total variable cost to be as 80,000 for silver. For gold also the same logic. For 400,000, if the variable cost, this is sales, this is variable cost, let me put it here. If it is 400,000 sales and variable cost is 200,000, now the sales has changed to 600,000. For 600,000, how much is the variable cost? Because there are no changes, other changes like selling price per unit, variable cost per unit, these things are not changing. Therefore, we've done this way and then proportionately we calculated. That's the only thing. Otherwise, also we can get into the other intricacies and ultimately we arrive at that point only. The amounts are 80,000 and 300,000. So contribution per unit, total contribution will be 200,000 minus 80,000. So we are asked to find out from gold package. It is 300,000. Alternatively, you can write alternatively. These are volume or units for silver, gold, 400 units and 200 units. If the sales at the present sales, which is 400,000 and 400,000, then the selling price per unit comes out to be as 100,000, 1,000 and 2,000. That is 4 lakhs divided by 400,000 is 1,000 and here it is 2,000. Variable cost is also given to us as 160 and 200,000. So we also got variable cost per unit. Applying the per unit part of it, because the total sales revenue only is changing in the ratio of 25 is to 75, which we already calculated 200,000, 600,000. The number of units have to be calculated. If for a sales volume of 200,000, how many units they must have sold? They must have sold 200 units. That is, each unit sold at a selling price of 1,200. So like that you calculate. I hope it's clear.
Yes, ma'am.
Yeah. Question number 117. Let's take it up. A nursery has produced the following budget for next year: fee income, staff costs, other direct costs, overhead costs, and profit is given. The nursery manager wants to stress test the budget for the potential change in staff costs, as it is rumored that a new nursery is opening nearby, which is offering a higher hourly rate to recruit staff. The manager is considering increasing its staff wages by 4% at the upcoming appraisals in a bid to prevent staff from leaving. If the manager increased wages by 4%, the revised gross profit next year would fall by. Okay. So he wants to stress test. We have learned the concept the other day. What is stress testing? That is making changes in the input to see what is the impact it would have on the output. We have various details given here, and the output is the profit. They have a profit of 14,062. If this is the profit what they have, in that case, it says that the nursery manager wants to stress test the budget for potential changes in staff cost, as it is rumored that new nursery is opening nearby, which is offering a higher hourly rate to recruit staff. The manager is considering increasing staff wages by 4%. So this amount will increase by 4% at the upcoming appraisal in a bid to prevent staff from leaving. If the manager increased wages by 4%, the revised gross profit next year would fall by. Simple. Only one variable is changing, which is staff cost. Make the changes to the staff cost, increase it by 4%, and see what is the impact it has on profit. No other change which is mentioned. The revenue is same. Fee income 150,000. Then staff costs, they are anticipated to increase by 4%. So 1.04. We see it is 65. 65,625 into 1.4%, no, 104%, so which is 1.04. That's written as is equal to minus 65, 625 into 1.04. The rest of them write as they are. Other direct costs, we have it as 28,125. Then we have overhead costs, 42,188. The present profit is how much? Present $14,062. Proposed profit after the changes is 11,437. Decrease in profit. Now we are asked to find out what is that percentage decrease in profit. Base will always be the present. If the present profit is 14,062, which is the base, so the decrease in profit is what percentage? So that's how we calculate. If this is 100%, because that's the base, um, the decrease is 2,625 is what percentage? So 2,625 into 100 divided by 14,000. 18.67%. Is that so? Okay, 18.67%. We have done 121, but 120 I don't think we have done. DPLC operates a retail business. Purchases are sold at cost plus 25%. The management team is preparing the cash budget and has gathered the following data. Budgeted sales are as follows. August, September, October. It's management policy to hold inventory at the end of each month, which is sufficient to meet sales demand in the next half month. Sales are budgeted to occur evenly during each month. Creditors are paid 1 month after the purchase has been made. The entry for purchase that will be shown in the cash budget for September is Are these the two same questions? I think 109 we didn't complete then. They look the same. 190, 125, 100. The figures are different. Purchases are sold at cost plus 25%. So the first point is purchases are at cost plus 25%. The management team is preparing the cash budget and has gathered the following data. For the month, we have August, September, October. These are the um, sales figures given. Management policy to hold inventory at the end of each month, which is sufficient to meet sales demand in the next half month. Sales are budgeted to occur evenly during each month. The creditors are paid 1 month after the purchase has been made. So, what should be the purchases amount is what we have to find out. Sales are given, but sales, how are sales made? Sales are made after adding 25% profit margin on cost, and then the selling price is decided. So, if the cost price is 100, profit margin is 25, then sales is 125. So each of these months sales are presented at 125% of the cost, fine, of the purchases value. Then there are certain details about what is the amount of closing stock which is held each month. The management policy is to hold inventory at the end of each month, which is sufficient to meet sales demand in the next half month. So the next half month sales will be the closing stock. Sales are expected to occur evenly. So creditors are paid 1 month after the purchase has been made. We have to find out what is the amount paid. Entry for the purchases that will be shown in the cash budget. So payment for purchases in the cash budget, cash paid to the suppliers is what is the entry we have to find out. So what are purchases is first we have to find out. After we find out what are purchases, then we have to look at see, closing stock is also calculated. Then how much cash was paid in each of the months is what we have to arrive at. This is first set of information what is provided to us. The first set of information says that the sales amount is 125%. These figures which I presented here as 90, 125 and 140 are 125%. So what is the purchases cost which stands at 100%? So that is first set of information. The second set of information talks about the ending inventory, that's the closing inventory. Closing inventory policy to hold inventory at the end of each month. End of each month is closing inventory, which is sufficient to meet sales demand in the next half month. So next half month sales will be taken as the closing inventory of each month. So closing inventory, let's write the policy about the closing inventory. What will be opening inventory if that is the case? The previous month's closing inventory is the current month's opening inventory. Previous month's closing inventory is current month's half current month's half sales. Sales demand in the current month's half current half month sales. When the purchases are made, the purchases are converted into finished goods. Then we have the conversion cost, the labor, overhead, all of them are incurred. The conversion cost is incurred. Then only sales can happen. So they're just not purchasing it and selling them, but they're converting um, because they are producing. There is a policy of opening and closing stock. If that was not the case, they would not have concentrated on what is the amount of the ending inventory, beginning inventory, which is maintained. So we cannot straight away take this one to be as the purchase cost. If they are not in the business of buying it wholesale and selling it in retailers. Um, no, it's a retail business only. No? Okay. So find out what is the purchase cost for each of these months. Start with August, then September, then we have October. Let's write what are the details we have. Sales for August is 90,000. That actually. Then this is 125,000 and this is 140,000. These are all at 125%. So we need to find out what is cost of purchases. Cost of purchases will be, if 90,000 is 125%, 100% is how much? So it will be 90,000 into 100 divided by 125. Then we have the closing inventory, closing inventory. Then we have to have the opening inventory details also. If we make the adjustments here, I think that will give us what is the so how do we calculate closing inventory? It is next month's half sales. We do not have November, so we cannot find out. Coming to the opening inventory. Opening inventory will be the current month's And here it will be this one. Purchases made. How much did they make? How many units did they purchase? So purchases made is equal to, what is the logic? The cost of purchases used in production plus the ending inventory minus the beginning inventory. That's the equation, no? Is that the equation? You remember what is the equation?
Yes.
Huh. So this, I'll put it as add. Yes. So the purchases value which was made is 86,000 and 106,000. But we are discussing about what is the payment part of it. See, if the purchases from the supplier was made to the extent of 86,000 in August, are they paying in the same month? They are not paying in the same month. They are paying in the next month. So August purchases of 86,000 will be paid in September. September purchases of 106,000 will be made in October. So cash payment made. Cash payment made will be, here it will be 86,000. Here it will be 106,000. Of course, all the months they are not asking, they are asking only how much cash was paid during the month of September. So that's 86,000.
Ma'am?
Yeah.
Ma'am, we have calculated closing inventory on the sales demand. So the sales demand here is the purchases, ma'am.
Huh. Sales demand is that, see, the inventory is always maintained at the cost value. The sale value is always inclusive of profit margin. But when we value the inventory, we do not add any amount of profit margin. Inventory is valued at cost. So the technically the value of sales is inclusive of the profit, but because that is inventory, we are eliminating. That's why we are not calling this as the purchase cost which they have made from the supplier, but the cost of purchase is included into the production part of it. So on that part, we are calculating. Even if we calculate it also, we again have to eliminate the profit margin. Profit margin which is included as 25%. Inventory is always valued at cost value. Therefore, we are not calculating it on sales value, but we are calculating it on cost of purchases value.
Okay, ma'am. Now I understood.
Yeah. I think the next two questions, 121 we have done. One simple question 123. We'll do this one and then wind up the class. The following costs have been estimated for the following period: direct material, electricity, indirect labor, rent, royalty, fee. What would be the total overhead budget for the period? So that is what is given. No other thing which is mentioned. So from this, we have to identify which of the following are overheads and which one are direct costs. So there's one item called as direct material which is given. Then certain other details are also given. So we need to identify which of them are direct in nature. The rest of them we can take them as overhead costs. That's as simple as that. First one, direct material, by definition, by the title itself, we understand it is not an overhead cost. So this will not come. Electricity is not proportionate with the um, production, because electricity, the example of semi variable cost, when we talk about, we take the example of electricity, isn't it? It is not identified because there is a fixed slab and a fixed monthly charges plus over and above based on the consumption, the charges are there. So it is not at all identified with the output. It is neither a fixed cost because there is one component which is fixed, one component which is variable. So that is an overhead, semi variable cost or overhead. So we go ahead with electricity. Indirect labor is also an overhead cost. Rent by nature, it is a fixed cost. Then rent is $6,000. The last one is royal fee. What is royalty fee?
Fees for using a specific design or something like that.
So it is usually calculated as the royalty fee paid per unit of whatever is that measurable unit. So by nature, it is direct expense. It is proportionate with the unit because the payment, when it is made as the number of units into per unit royalty fee. So the by nature, it is a direct cost, it is a variable cost. So this also will not come. Fixed cost of rent will be the same, 6,000. As the number of units keep increasing and decreasing, we see that the fixed cost or the rent cost per unit also keeps varying. It is not proportionately identified. Therefore, we have the total overhead budget for the period as 8,750, 37,500, 6,000. Just add them up. 37, 43, 51, 52, 250. 52, 250, is that the answer?
Yes, ma'am.
Okay. So let's wind up the class here today, and tomorrow we'll again meet and then continue further with the remaining questions. So this speak. Okay, fine. We'll end the class here.
Okay, ma'am.
Okay, then good day. See you tomorrow, same time, 4 o'clock.
Thank you, ma'am.